Yeah, so that's what we've seen in cases this year with, I think we saw with Argentina and maybe even Pakistan, where they've, in some ways, so this is, so what these countries did, right? They were running out of dollars. They're financially strapped, and they need to, they still need to pay for their goods from China. And so what they do is they use the swap line. That is, China says, we'll give you RMB, and you pay us back this RMB in a short period of time, and we'll take your currency as a deposit in exchange for that in the meantime. And then it's almost like producer finance. China says, we'll loan you RMB, you buy our goods. Uh, so a couple of things occur to me about it. First, it's a bit like lemon socialism. We call
Mm.
lemon socialism, where it's a failed company, a failed, it's an emergency situation. And that's when they find the employers find it in their heart to let the employees have shares in the company, right? And so this is the sort of the same kind of way that I'm in Argentina. I've run out of dollars. I've got a very few dollars. I need those dollars to pay the IMF or some other purposes, but I still need to buy these goods from China, and so I'll borrow money from China. I'd say that this is a case not of supplanting the dollar, but sort of supplementing the liquidity. And again, the challenge though is think about like you're Argentina or Brazil, and you've got dollar bonds out there. You've borrowed dollars,
Hmm.
and now if you're just going to accept RMB as your source of revenue for the goods you sell abroad, you have a mismatched book. And that book of so you're selling it's sort of like same thing with Saudi Arabia, right? They peg their currency to the dollar, which means when the Federal Reserve is going to raise rates later this month, uh, the Saudi monetary authority is going to have to raise interest rates. They're pegged to the dollar. They get dollar primarily for the goods that they sell. And so then what happens? They're going to take on RMB, and then it gives them a currency they have to manage, as opposed to just doing everything in dollars. And so you end up running a mismatch of a book of your like assets and liabilities in different currencies, which makes it, which maybe is also maybe a point you're making too, is that there's a bit of inertia behind it, behind the role of the dollar, and that it's not that it's impossible, but just that it's going to take more thinking about it and maybe a bit longer to change the inertia to so begin having then Saudi Arabia. Maybe that's something else China can do is encourage foreign countries to issue what we call panda bonds, RMB bonds in China.
Right. That's an interesting one. And
Well, that's why I think that like when we're thinking about the capital markets, why I think that there's some ideas that maybe the dollar could be replaced by some kind of commodity-backed currency, whether it's gold or a basket of commodities. And there's something about it that's intuitively like desirable, something that you can touch. I mean, that's the whole idea. What fiat means, right? It's not backed by gold or silver. On the back of my dollar bill says, it's like legitimate tender. That means that anybody who I owe dollars to has to take that, my legal tender. Um, but we know it's not really backed by anything except like it's almost like a confidence game. And so imagine a currency. I think many of us would have more faith, higher confidence in a currency that we know is backed by something. But here's the challenge with that is that the foreign exchange market is an incredible turnover. And the place we could get this data is from the Bank for International Settlements. They have a survey every 3 years about the size of the foreign exchange market. Average daily turnover over $7.5 trillion. $7.5 trillion a day. It's just mind-boggling what that is compared to like any of these commodities you want to measure, whether it's soy, gold, aluminum, even all of the world's trade in a year is no more than say 50, 60 billion, $60 trillion. We do that in 10 days in the foreign exchange market. The world's GDP is roughly speaking $100 trillion a year. We do that in a month in the foreign exchange market. And that's just one segment of the capital markets. And so I just think that what's happened in that Reagan-Thatcher era that we still sort of are living in the aftermath of created these huge financial superstructures of a place to store this surplus savings, of this like great wealth of art, not just of our time, but of all of our, like all of humanity, all the wealth. We don't just store it in museums, but a lot of the wealth is in liquid form, dollars, euros. It's in stocks, it's in bonds, and that's what we're really trading. That's the store of our. That's where we put our savings for that rainy day. And for where we are at different places in our life, people close to retirement maybe have more savings than people right out of school, where they put that savings until they need to use it. And so that financial superstructure, where we put all the savings, has that's like if you look at it as a balance sheet. There's assets on it, and there's liabilities. There's assets and there's debt. And so many people talk about, well, there's too much debt in the world. That to me is another way of saying there's too much savings in the world. And so I don't see how commodities at current prices, I mean, say gold $2,000 an ounce or so, I don't see that being anywhere big enough to really supplant or even supplement in a very significant way this sort of superstructure of finance that's been created.